Today, I want to talk about equipment manufacturer financing programs and some of the things you want to consider when looking at this source of business financing. When you're looking at purchasing equipment from a dealer, it's not uncommon that the vendor will have a manufacturer financing program available for any of the major brands that they're selling. Manufacturer financing programs can be a great source of financing when the cost of capital is similar to the market at large for a similar financing request. Depending on the amount of financing needed, the application information required by these manufacturer financing programs can be pretty minimal, and the turnaround time can be very fast. But when the cost of financing is higher or lower than the rest of the market for a similar deal, there are some things to watch out for. Let's start by looking at below market rate offers. Let's say that the current market rates are about 7%, and the manufacturer financing rate being offered is 3%. In this scenario, the manufacturer's rate is likely being subsidized internally to get to that 3%, which means that part of the cost of financing is either being added into the sales price or it's coming out of the vendor's margin. It's not at all uncommon for resellers to play a packaging game with interest rates and price in an attempt to increase the appeal of their products to their customers. If the manufacturer's financing rate is subsidized by increasing the purchase price, then there's no net gain to the purchaser. The cost is just being moved from interest to the purchase price to create better price-rate bundling. If any rate subsidy is being paid by the vendor's margin, it's a clear and transparent gain for the purchaser. The best way to tell if you're actually getting a benefit is to request a quote for both a cash price and a finance purchase price and see if there's any difference. You may have to go to multiple dealers to get to the true picture, but it may be well worth the effort to uncover if there actually is a financial benefit to be gained. At the other end of the spectrum are manufacturer financing rates that are above the market rates. These types of financing programs are typically easy to qualify for with no money down and in some cases no repayment period for several months. If you were to ask the vendor for a cash price versus a financing price, many won't provide a cash price option as everything they sell is internally financed. This is likely because their business model makes more money on the financing than it does on the equipment margin. In this scenario, the purchase price plus the cost of financing is likely going to be higher than the market at large. Under this pricing scenario, the vendor is trying to appeal to potential customers that are more cash flow constrained and that will respond favorably to offers that conserve their cash both at the time of purchase and for months afterwards. So regardless of the financing source or ease of access to capital, it's always good to know both the cash price and the financing rate so you can do your own apples-to-apples comparison on purchasing options. If you do see a manufacturer offering a lower than market interest rate or no interest rate at all, it's likely a good idea to collect a bit more information, do the math yourself, and see if what's being offered is actually a benefit to you. So once again, equipment manufacturer financing programs can be an excellent source of capital to your business. Just make sure the numbers make sense and they're providing a true benefit to you. If you have a business financing problem, challenge, or requirement you'd like to discuss, you can give me a call or send me a note at the information provided at the end of this video. I look forward to speaking with you. Take care.